Hi folks, welcome to this video on ratios. Now here's an example of where we give you what the actual ratio is for each company, and you have to tell us which one is the most solvent, which one is the most profitable. In the first case here, which one is most likely to meet its short-term obligations, and the one that generates the most sales revenue from its asset base. So these actually make great multiple choice little questions too. But in this question, I set it up as I did so I could see whether or not you knew which ratios to look at. So in this particular case, we've got net profit margin, return on equity, inventory turnover, current ratio, debt to asset turnover ratio, and gross profit percentage. Which one of those would we look at to determine the company that's most likely to meet its short-term obligations? Short-term obligations. Which one would that be? Well, short-term obligations are those that are current liabilities. So you might say to yourself, well, let's look at the current ratio at this point and see what we have. Well, for sure, because the one where the current ratio is bigger means what? It means it's got more current assets than liabilities. So the more current assets they have, the more likely they are to be able to pay off their current liabilities. But we look at it as a ratio. So if you go back to your formula sheet, and this is the formula sheet you'll get on the exam, you'll see here that the current ratio looks at current assets divided by current liabilities. So the company that has this, the largest over the number 1, would be the one that has the largest current ratio, right? And if whoever has the largest current ratio is the company that is most likely to be able to meet its current or short-term obligations. So we're looking for the company that has the biggest current ratio, because that's when the current assets will be the most biggest over current liabilities. So in our case, who has the largest current ratio? Well, that's JCPenney, right? So they're the ones that are going to be most able to meet their short-term obligations because they're going to have more current assets to meet their current liabilities than does Kohl's, because they've only got 2.08%. Now, let's have a look at the one that's the most solvent. Whenever we talk about solvency, we're always talking about debt to asset ratio, because we're looking at solvency in the long term and in the short term. It just says the most solvent. So over the longer term, who would be the most solvent? The one with the lowest debt to asset ratio. Remember, the debt to asset ratio is the one that shows us total liabilities to total assets. So the one that has the most assets and the least liabilities, because that's where the ratio will be the smallest. Well, they gave us the ratio. We didn't need to calculate it. So the one with the smallest debt to assets is Kohl's. So Kohl's would be the one that would be in the longer term the most solvent company. Now, which one is the most profitable? Well, we'd look at all the profitability ratios. We talked about these profitability ratios earlier on. Net profit margin, gross profit percentage. Gross profit percentage we introduced in a previous chapter. Net profit margin as well. And return on equity was just based on the most recent chapter that we did. But in any case, the one that's the most profitable will have the largest ratios here. So we can see Kohl's has the largest net profit margin ratio. Who has the largest gross profit percentage? Okay, it's not Kohl's, it's JCPenney, so we're going to highlight that. And then we got the return on equity, and return on equity, by far we see Kohl's is the largest. So given that we have 3 measures of profitability, who has the most? Who has the most green guys here? Kohl's does. So we would choose Kohl's because they have of all the profitability indicators, 2 of the 3 are highest for them. Now, you might say, well, what about the fact that gross profit percentage is higher in JCPenney? Well, you can see, to be honest, it's not that much higher than Kohl's. So given that the net profit margin of Kohl's is so much higher than JCPenney, as is the return on equity, plus the fact that 2 of them, they beat out Kohl's, or they beat out JCPenney on 2 of the 3, we would definitely pick Kohl's as the one that's most profitable. And the one that generates the most sales revenue from its total asset base, again, we'd look at the asset turnover ratio. Why? Well, if we look at our ratios, it's looking at generating the most revenue from its average total asset base. So that means you use this ratio. So if we go back here and we calculate that, we want to find out where is the asset turnover ratio the highest, because again, bigger is better except for that debt to asset ratio. But where is the asset turnover ratio biggest? Well, we can see it's biggest with the, I don't like that color. I'm going to pick a different color. I'm going to use gray. I use that guy, gray. Okay, so we can see there that the asset turnover ratio is greater for JCPenney. So that's the organization that's generating the most sales revenue from the total asset base. So the one with the highest asset turnover ratio, okay, which is JCPenney, that's the one that's going to generate the most sales revenue from its total asset base. And again, you can see this from the formula. Net sales revenue over total assets. When this ratio is bigger, it means they're generating more sales revenue from their asset base than is its competitor, in this case, Kohl's. So that's how we know. So anyway, this concludes our other video on ratios. I hope you found it helpful.